Google stock is down over 20% year to date, and that doesn't include the nearly 5% decline we're seeing in the shares in the after hours. Are we stepping in and buying the dip on Google as we head into the rest of the trading week? What is going on, investors? Hopefully you guys are doing well out there. That is right. It's time to talk about Google after the company reported their Q1 earnings after the bell today. We'll take a look at the revenues, the profits, the different divisions that Google operates in, see some of the costs and some of the expenses that impacted profits. We'll take a look at the balance sheet, cash flows, everything that you need to know with Google. We'll also talk about this from a traditional valuation metric. Surely there's going to be people jumping in the comments and saying the price to earnings this, the price to sales is this, the price to cash flow is this with Google. Are these some of the lowest levels that we've seen with Google? Is this truly starting to become a value stock? And then we're going to look at this from a technical perspective as well. If you've been following this channel any length of time, we cover this stock on our FANG Stock Recap show every Friday, and we've noted for basically a year now there's been areas of support for Google down here at about $2,500 per share, where last week we sliced through that, and we're seeing in the after hours we're going even lower, down to close to $2,250 on this stock. Talk about what that means from a technical perspective. Now, Google did report their Q1 earnings. Those came in at $24.62 per share. That did miss expectations by $1.14. Now, they also came in on that revenue side, but they actually beat on that revenue side, coming in at $68 billion, almost flat. That was 23% year over year growth on that revenue side. But one thing that we want to keep in mind with Google is, where does Wall Street have this growth rate? Because when we come over here and look at price to earnings, price to sales, price to cash flow, and then we walk through these earnings, we have to factor in that Wall Street is valuing Google not necessarily on the last 12 months, but the upcoming 12 months. And Wall Street very much accurately predicted Google's revenue growth year over year in the most recent quarter. I just told you they beat by 23% year over year on that revenue growth. That's exactly where Wall Street had them pegged. In fact, just slightly under that. Now we look forward over the next year, nearly 2 years, even longer than that with Google, and we're seeing that Wall Street has actually slipped the valuation down on Google down to kind of the mid-teens, and then occasionally even all the way down to the low teens, and all the way down to about 11% grower about 2.5 years out on Google. So when you factor in your valuation with Google, understand that it does have a little bit to do with the results today and over the last 12 months. But for the most part, investors are looking forward 12, 24, 36 months with Google. And we're seeing that Wall Street's pretty accurately predicting this company. And Wall Street is starting to rein in their expectations on that year over year revenue growth. That is certainly going to impact earnings as well, because we talked about how this company missed their EPS by $1.14. We see here with Wall Street, earnings growth is basically going to shrivel up for the rest of the year. You're essentially going to have close to break even or just kind of low single digit revenue growth over at Google for the next year on the earnings side. Now, it is projected to pick up a year from now with Google, but who knows if those predictions will turn out to be true or not. Those are certainly things that are weighing on Google shares. Now, let's jump into the numbers before we get to more of the valuation stuff. Let's jump into these numbers over at Google. Talked about how they had $68 billion worth of revenue. Here's kind of the high-end look at it. On that Google search, essentially the core product, nearly 2/3 of revenue coming in just on that Google search, $39.6 billion. Last year on a quarterly basis, you were sitting closer to 31.9. You have YouTube, where most of you are watching this right now. You went from $6 billion worth of revenue up to about 6.8. That appears like it's slowed down in terms of its growth rate into previous quarters. You also have Google Network, which is essentially kind of the network of sites that show AdSense and things like that. That accelerated actually pretty nice, from 6.8 up to 8.1. So your total Google advertising business year over year grew by about $10 billion. You went from 44.6 up to about 54.6. You do have some other revenues over at Google, but they're rather inconsequential. You come down to the other key business that a lot of investors look at is this Google Cloud. Again, really solid revenue growth year over year. You went from $4 billion up to $5.8 billion, but I'll show you in a minute, these segments don't make any money. So we come down here to operating income, which is essentially kind of the income you generate off of these business. We've got Google Services, which is all your advertising businesses and your online stuff. Off of $61.4 billion worth of revenue, you had nearly $23 billion worth of operating income. You see here on Google Cloud, what I notice is despite the strong revenue growth, again, you went from 4 billion up to 5.8 billion. Notice what happened to our operating results. They essentially stayed flat. So you lost 974 million last year on a quarterly basis, and this year you lost 931 million despite adding $1.8 billion worth of revenue to that business model. Is showing me that there's still a little ways from profitability on that Google Cloud. And then obviously you have other bets as well that lost $1.1 billion off just $440 million worth of revenue. Now, when we come over to the financials, they paint an absolutely glorious picture, quite frankly, basically across the board over at Google. You've got over $130 billion worth of cash. That's down a little bit year over year, or essentially from the beginning of the year is when this balance sheet starts. So about 3 months in, we're down a couple $1 billion. I will show you where that went here in a moment. I'm sure most of you can guess. Come down here to long-term debt, basically flat year over year on that, but just 14.8 billion, and you have $133 billion in cash. From a balance sheet perspective, quite frankly, it doesn't really get anything better than with Alphabet. Now, the other thing that you have to keep in mind with these, $133 billion, will show you the positive cash flow that Google has in a minute. Yes, we talked about how they have a $70 billion, yes, a $70 billion buyback on this company as well. Certainly that's where a lot of this cash is going to go. But even if you minus off $70 billion, you still have a lot of money. I mean, they could have bought Twitter. They could have bought a lot of different things if there was a regulatory environment there that allows Google to do that. Obviously, we don't have that here in the United States, and it's not President Biden's fault. If there were Republicans in office, they probably wouldn't be letting Google buy whatever companies they want either. It's more the philosophy of Washington right now to not allow quote unquote big tech to get any bigger through acquisitions. So they're going to have to do some creative stuff with this cash. We'll talk about maybe later on the show some things that they could potentially do. Now we come down here to the statement of income. We talked about how they had that $68 billion worth of cash. Again, that's YouTube. That's the other bets. That's all the advertising stuff. And that's also their cloud business has $68 billion worth of revenue. They were sitting at $55 billion in the previous year. You see here on the total cost and expenses, you went from 38.8 up to about, we'll call it 48. So they added about $10 billion to their cost year over year, slightly under that. And they added a little over $13 billion to that top line revenue. Now, some things change though after you get underneath their income from operations. So your income from operations, which is typically the line we really focus on here on the investor channel. So you've got your revenue, you've got all your costs to run Google. So in the most recent quarter, you had $68 billion worth of revenue. You had $47.9 billion worth of costs. You come down here to income from operations sitting right at $20 billion. You see last year, it's nice growth rate year over year. You went from 16.4 up to this nearly $20.1 billion. But when we're talking about a traditional valuation metric, like a price to earnings, they come all the way down to net income. So that means Google needs to pay their income taxes, and they include other things like other income. Notice this last year on a quarterly basis, Google recognized $4.8 billion worth of other income. My guess is they had an investment in a company and they sold out of that investment. And so when you come down through there and you factor in income taxes as well, net income on Google was $17.9 billion last year. Again, on just $16.4 billion worth of income from operation, you factor in that $4.8 billion, they actually had more net income than income from operations. Now, this year, it's exactly the opposite. Instead of getting a benefit from other income, it looks like Google lost money on some kind of investment, or they divested on something, or some kind of accounting rule made them recognize a $1.1 billion loss in the most recent quarter on that other income side. They pay their taxes, and despite the much higher from income from operations, despite the higher revenue as well, you come all the way down to net income on Google. You went from 17.9 down to 16.5. So these are the things that skew earnings per share, beats or raises, or all those types of things when you look at the press releases. So I just want you to understand that with Google, that The operating income, very nice with Google, but compared to a year ago period, they were able to recognize a $4.8 billion gain on an investment, and that really impacted their most recent quarter because they had to do the opposite. This year, they actually recognized a $1.1 billion loss on income. And obviously, we're dividing earnings per share by the number of shares outstanding. We talked about how Google already has a buyback in place. They've added another $70 billion to it. So your number of shares outstanding actually went down as well. That's why when people point out, hey, Google's price to earnings is pretty low. And here's a 10-year chart of Google's price to earnings. Right now, they're sitting probably very close to 20. And you see that's pretty much a 10-year low on this company. But factor in, some of that is being bolstered up by the fact that this company is buying back its shares, so therefore reducing the number of shares outstanding and artificially inflating their earnings per share. But on top of that, they have these other investments that occasionally skew their net income as well. Just some things to think about if you're an investor. Now, come down to cash flows over at Google, and we pull down this net income number of 16.4. This is where you get to add some of that stuff back in and get another clear view of the company. Again, with Google, I would tend to stop at this income from operations and say, hey, this company went from $16.4 billion up to $20 billion on that income from operations. That's fantastic. You see it paints the same story here on cash flows. You went from $19.2 billion worth of positive cash flows last year on a quarterly basis all the way up to 25. That's absolutely fantastic. You come down here, you see that they're repurchasing the stock at $13.3 billion. It looks like they've refinanced some debt in the most recent quarter. They took on $16.4 billion worth of debt, but they repaid $16.4 billion worth of debt, essentially just a refinance. This company has plenty of cash flows. In a quarter, this company is producing $25 billion worth of positive cash flow. The company already has $133 billion sitting in the bank. So this $70 billion buyback, it is gigantic and it's huge, but this company can, quite frankly, pretty easily afford it. Now, two other traditional valuation metrics before we get to the technicals over on Google is the fact that we'll look at price to cash flow. So we talked about here from a cash flow perspective, Google's looking really good. $19.2 billion worth of positive cash flows to 25. You annualize a number like that out based on earnings estimates, and we get to price to cash flows over at Google sitting close to about 17, 16 times. Again, when you stretch it out to a 10-year chart, that is pretty low. It's not as low as it's been. Google's been as low as under 15 times price to cash flow, something to keep in mind as well. Now, probably my favorite traditional valuation metric is simply price to sales, because there's no way to manipulate a sale. A sale is a sale at any company. You can't manipulate it through buybacks and those types of things. We see that Google is actually still a little expensive, in my opinion, from a price to sales perspective. They're sitting close to 6 times price to sales. The rock bottom price, or near the rock bottom price on this company, is closer to 5 times sales. Again, we're getting there really close, but I want to remind you that we've got to factor in, we're going to low single-digit growth on the earnings side, and we're projecting over at least the next 2 years, maybe 3 years, maybe into infinity with Google. We're going down to like mid-teens growth on that one. That one's also going to impact the multiple that Google gets from an earnings perspective and a revenue perspective going forward. Now, from a technical perspective, this is a disaster. I wouldn't want to step in on this one at all. We are in a massive decline on this one. We have broken a key area of support down here at about $2,500 per share. We're now down here closer to about $2,200 per share. The thing to keep in mind is, yes, you can absolutely buy the dip if you want to in Google, but we can pull up charts of Netflix and PayPal and Alibaba and a lot of stocks that have gapped down and started to make this mountainside move, and none of them, I mean, we're talking about none of these stocks has bounced back. Now, Google's certainly more financially secure. Certainly a $70 billion buyback will help the stock as well, but we have to factor in there's going to be overhead resistance on this one back at the previous area where we had stopped at here at 23. We'll also have overhead resistance here at 25. So your upside from 22 is back up here to maybe 23, maybe on the upside back up to 25 before you start to see some sellers step in on this stock. Me personally, I would just simply wait on this one. We do have the split coming up in July. If you don't have access to fractional shares, could be something that you wait for. We do have some areas of sideways consolidation down here at about $2,000 per share. There was some nice sideways consolidation with Google, really only though for just a couple of months. Quite frankly, it looks like this is the range we want to pull into. I really wouldn't consider buying Google shares. Again, if you already own Google shares, if you want a dollar cost average into them, look, I'm not going to tell you what to do. If you're a newer investor, you have absolutely no exposure not only to Google, but the online advertising space. Well, again, from a valuation perspective, you're not paying like a crazy price for Google really across the board, from earnings to sales to price to cash flow. But do keep in mind that the multiple is probably going to stay compressed over at Google just by the fact that they're not going to have really strong revenue or earnings growth for at least a year, maybe even 2 years over at Google. Right now, this business looks really good. I am picking it apart and nitpicking it when you've got $25 billion worth of positive cash flow off of $68 billion worth of revenue. There are very few companies, in fact, almost zero companies in the world that you can invest in that have that type of performance. I love Google. I would continue to add this on the dips, and I will likely do that, but I will allow this stock to take a little bit of a breath because like we talked about, there is upside resistance back at 23, back at 25. I don't think you need to rush into this one because I don't necessarily see a really sharp V-shaped recovery in this stock in the shorter term. The growth rate just simply is not there with Google to help it expand its multiple and have the stock continue to move higher. But you are supported by the fact you've got a $70 billion buyback on this one. I would expect the company to come in and support the shares at some point, but I don't think it's going to be this massive V-shaped recovery in stocks like Google. They're pretty fairly valued, and considering the growth rate, they're not really going to grow their market share or their revenues or the profits over the next 2 years. That is going to be difficult for investors to really pile into a stock like this, considering it doesn't pay a dividend and it doesn't provide some of the other value stock safeties that we see in other parts of the market. That was Google. Hopefully you guys enjoyed today's video. Lots more. Good luck with your investments.